Good morning, everybody, and welcome to today's financial reporting update. My name is Nicholas Guest. I'm a partner here at HLB Manjard. I would like to acknowledge that I'm hosting today's session on the lands of the Gadigal people of the Eora Nation, and I'd like to acknowledge the traditional custodians of the various lands on which you are all sitting today, and the Aboriginal and Torres Strait people participating in this webinar. To kick things off this morning, Jolyon Dare, partner in our tax consulting team, will be providing an update on our tax-specific matters that may be of interest to you and impacting you and your organisations in the coming days and weeks and years. Joel is a highly qualified tax partner and the head of our Sydney tax division, and Joel is recognised as a thought leader due to his understanding and commercial application of taxation matters. So without further ado, I'm going to pass over to Joel.
Thanks, Nick, for that intro. Today, I wanted to talk just about Pillar 2 because bearing in mind that we're focused on financial reporting today, I often talk to clients about the tax aspects of Pillar 2, but I can see that in terms of financial reporting, understanding how the Pillar 2 framework works and will apply to taxpayers and clients in Australia and around the world is really vital. There are a lot of parts or working pieces to it to understand. It's quite a complicated series of measures, and it would be quite easy, especially at the start of these Pillar 2 implementation for clients, taxpayers to get their disclosures incorrect. And of course, that the timing on that, although often we will talk to clients who have needs around reporting Pillar 2 or potentially even paying tax under Pillar 2, we tend to talk about the time when that will have to be lodged, which is still, for a lot of people, 12 months away. But of course, for financial reporting purposes, it's very much now. So I want to run through some of the key aspects to be aware of so that at least you can identify, hopefully, what kind of risks might be implicit or what kind of reporting obligations you might have as a result of Pillar 2 if you're part of an affected group. So I started this one off by saying we just pay 15%, we're okay. Well, I wish it was that simple, but as we'll run through, there's a few quirks and twists in here where it's a little bit more complicated than it seems even at first blush. So first one, are you in Pillar 2? Your basic criteria are you part of a multinational group with 250 million euros turnover per annum? And that can be slightly different from the amounts that are appearing on your financial statements because it takes into account sort of a notional multinational entity, the ultimate parent group, and the turnover for that group. So it is quite possible that what you have on your financial statements in Australia and how you actually test the $750 million turnover is quite different. So you need to be looking at the entirety of the economic group, tracing all the way up the ownership chain to the ultimate parent entity to determine whether or not you do have 750 million euros of turnover. That is, are you in the Pillar 2 criteria? I thought I'd come out with sort of 4 fatal messes, I call them here, for Pillar 2 and things that taxpayers or clients are thinking themselves, maybe I don't have such a big issue to deal with, and I thought I'd draw out some of the issues that are here in terms of the assumptions that sit underneath these kind of statements. One is, well, effectively our group pays 15% tax. We can't have a Pillar 2 impact. Even on a global basis or an Australia basis, that's not quite right. So when you're testing whether or not you're reaching the mandatory 15% effective tax rates, it's necessary to take what they call as a jurisdictional approach. And that means inside every particular tax jurisdiction across whatever MNE you are part of, you have to be paying 15% in that jurisdiction. And so that presupposes that you actually have an awful lot of visibility around what kind of effective tax rates you've got going on within your multinational group. And to the extent you don't have that visibility, you haven't coordinated it, you do have a risk that there will be in some form a liability for Pillar 2 taxation somewhere in your group and potentially in Australia. even though those activities might not be part of your existing general financial reporting framework. Another one, as I referred to before, is that you can't just look at your turnover from an Australian perspective. It has to be on the basis of the global turnover. So it's one of these things where to comply with Pillar 2 and to get the disclosures or risk of misdisclosure addressed, you really have to understand how the group is performing, what its global turnover is, and what the effective tax rates are in each jurisdiction to make sure you address the possibility that there could be a liability for Pillar 2 tax. The next one here is that for tax purposes, often we're sort of 12 months away from actually completing the forms, which we don't know what they are. The legislation's still unsettled, and yet there's a possibility for Pillar 2 tax to be applicable right now. We've got two measures that I'll talk about today that have applied for periods commencing on or after the 1st of January 2024. So it's actually for reporting periods that have already taken place. And a third backstop measure, which is probably the most complicated one, which is deferred to application for periods starting on or after the 1st of January 2025. So this is the potential liability for taxes under Pillar 2. It's already live, and it's already live. Either you've already gone through a reporting period that covers one of these, or alternatively, you're probably just about to come into a period now where you've got a potential need to disclose or address a potential Pillar 2 taxation liability. And the last myth I wanted to debunk here is really that you can get your Pillar 2 disclosures without understanding the rest of the group, including entities above you in the corporate group. As I'll touch on a little bit in the next two slides, it is possible for you to have a liability for Pillar 2 in relation to a sister entity and also in relation to subsidiary entities. It can also apply in some cases to entities that are just part of your multinational group. And so understanding how your group is set up and what the jurisdictional approach to each one of the locations in which your multinational group is located is critical to making sure you get your Pillar 2 disclosures right. Tax is not tax without a whole bunch of acronyms, and here they are. Qualifying domestic minimum top-up tax, which rolls off the tongue beautifully as QDMTT. You're going to hear a lot more about QDMTT. This is, in really simple form, a domestic tax which applies just within Australia to situations where a local Australian effective tax rate is less than 15%. It's contemplated in the legislation for the QDMTT that actually it will be unlikely to apply in most cases because most taxpayers in Australia are paying at least 25 and more likely a 30% effective tax rate. Now, that's probably a generalized statement. Of course, there's a whole bunch of different reasons why you might have a disclosed tax rate in your financial statements significantly less than that amount. And where you do have that type of disclosure, that's the moment at which you have a consideration of whether or not you have a QDMTT liability in relation just to the domestic operations. Now, the QDMTT is also part of the implementation of the GLOBE rules. So for all of those countries that have adopted the recommendations for Pillar 2, they will, generally speaking, be implementing a domestic minimum top-up tax similar to Australia. And what that does is, to the extent you've got an effective tax rate in the jurisdiction, the first taxing rights go to the local jurisdiction to top the local tax up to 15%. That's, I suppose, the first rule that we need to interpret and have in mind. Backing that up, there's the income inclusion rule, which also applies from the 1st of January 2024. And what that does is, if there are, for example, subsidiary entities of an Australian group that have an effective tax rate in that jurisdiction less than 15%, and they don't have, for example, a qualifying domestic minimum top-up tax that's implemented, then the taxing rights flow back to, in the first instance, the ultimate parent entity to tax up to 15%, or if the ultimate parent entity is not has not implemented Pillar 2, it can go into an intermediate parent entity. So what does that say? It says that if you do have part of your multinational group, which is a subsidiary of your Australian group, then they have a potential income inclusion rule which can subject the Australian entity to top-up tax up to 15%. If you don't have a QDMTT in that jurisdiction and the effective tax rate in the jurisdiction for a particular year is more than 15%. The final rule, and this is a bit of a backstop rule as is contemplated under the globe, is the undertax payment rule. And this catches a situation where in Australia, if you've got a group which doesn't have any parent entities that have implemented Pillar 2, and there's a reference there in the link that I've provided to, in particular, some jurisdictions like the US and Indonesia, China and Taiwan have not implemented it. If you're a group that is based out of those regimes, out of those jurisdictions, sorry, then you can be subject to the undertax payment rule, because if they have not implemented Pillar 2, then a less than 15% effective tax rate can't be picked up through either a qualifying domestic minimum top-up tax in those jurisdictions, or alternatively through an income inclusion rule. And in that case, you can get to a situation where, in relation to some other entity in your corporate group, which you're not actually the parent of, you can be subject to a top-up tax in Australia to collect the undertaxed amounts, which can happen in a different jurisdiction. And so I've just put together, this is ripped straight off the APH website. I did actually put the reference in there. I'm trying not to be like certain things that we've seen in the media recently, and not giving credit for my baking recipes. So you'll see there that that's a reference to the APH site. So this just gives an entity or a nice little description here of how the different ways in which you can be subject to Pillar 2 taxation. So we've got it. Oops, sorry, one slide back. Thank you, Tanya. You've got your low taxed constituent entity on the bottom left there. Now, if it is in Australia and you're less than 15%, then the qualifying domestic minimum top-up tax applies as a priority. So Australia gets to tax the effective tax rate of less than 15%. Now, if you've got a low tax constituent entity here in number 2 that is not in Australia, but you do have an entity up in the higher in the ownership chain, and I suppose our ultimate parent entity could be in the number 2 there in Australia, and you've got in a particular jurisdiction that low tax constituent entity with an effective tax rate under 15%. Then a taxing right arises to effectively apply a tax up the ultimate parent entity in relation to the low tax constituent entity. Now, it could be that you, in number 3 there, your ultimate parent entity is in a jurisdiction that hasn't implemented Pillar 2. But for example, if you've got the Australian entity is the intermediate parent entity, and the low taxed constituent entity at number 3 there is in a jurisdiction that has an effective tax rate under 15%, then the taxing rights go to that intermediate parent entity through the income inclusion rule. So if you are that entity in Australia at number 3, that's the intermediate parent entity, that's a situation in which you can be subject to Pillar 2 tax in relation to an offshore entity at the bottom left. And finally, at number 4 there, you've got a low taxed constituent entity in an overseas jurisdiction for which all of the parent group has not implemented Pillar 2. That is, there's no income inclusion rule applying in those jurisdictions. In that case there, you can see on the bottom right there, the constituent entity, and that could be an Australian entity, can be subject to Pillar 2 tax in relation to an entity that's actually a sister entity with. And so I suppose what I'd take away from all of this is you've got 3 different interlocking rules there, and each one of them have the ability to apply taxation to the entity that's marked out as blue there. In relation to a low tax constituent entity. So you can effectively be almost anywhere in the corporate group and subject to Pillar 2 tax. And that is what makes it so challenging from making sure that your statement of liabilities in relation to tax are correct. Because without a comprehensive knowledge of what's going on in your corporate group, it becomes extremely difficult to be able to track whereabouts and how, if at all, you might have a Pillar 2 tax obligation for. effective tax rate somewhere in your corporate group in the world, which is under 15%. Last slide from me here is, this is just a nice little illustration of how 15% across your corporate group is perhaps not all that you need to do, and in fact, in most cases, it won't be. So I just have the example here of if you've got an ultimate parent entity, what you need to do is effectively work out your effective rate of tax in each of the jurisdictions that that multinational group is operating. So it's not enough to just be paying 15% on an aggregate basis across your corporate group. You have to apply what they refer to in the rules as a blended jurisdictional basis. And what that means is you have to look at each tax jurisdiction on a jurisdiction by jurisdiction basis to determine whether or not within that particular jurisdiction, your effective tax rate is less than 15%. So you can't just average them all out. You do, in fact, need to undertake this exercise across each particular jurisdiction. And that's where you can see the complexity really comes in for multinational groups that have deep groups and operating in multiple jurisdictions, is that it assumes that you've got a very high level of visibility and knowledge around effective tax rates across the various different jurisdictions that your group is operating. So in this example here, you can see that the effective tax rate in jurisdiction Z, the bottom jurisdiction, is effectively lower than 15%. So if that did have a qualifying domestic minimum top-up tax, the domestic minimum top-up tax would increase the effective tax rate in the jurisdiction to 15%. And if they haven't got a domestic top-up tax to have that impact, then what will happen is that if jurisdiction X has implemented Pillar 2, and that's what happens in the top there, will be subject to the top-up tax in lieu of jurisdiction Z. So the fact that actually in jurisdiction Y you're paying a lot more than is required isn't enough to mean that you don't have an issue in relation to Pillar 2 top-up tax when you're doing your ultimate parent company financial statements. And that gives you a little bit of a feeling for how complicated it can be to make sure that you have managed whatever your liability to Pillar 2 tax is when you're operating a group, especially one that has a number of different jurisdictions in which it operates. And that's all from me.
Thank you, Joel. That was very informative and a lot for us to keep an eye out there for in Pillar 2. I'd now like to introduce Michelle Warren, who is the Director of Corporate and Financial Reporting at HLB Man Judd Australasia, and Carmen Ridley, the Director at Australian Financial Reporting Solutions. Michelle provides leadership on corporate and financial reporting matters across the HLB Australasian network. This includes overseeing the network's thought leadership on climate and financial reporting issues and developing and delivering technical training and content to meet the reporting requirements of the network and our clients. Carmen Ridley specialises in providing financial reporting advice, accounting standards interpretations and technical training. Carmen has acquired this excellent knowledge of financial reporting matters through her significant experience working with a broad range of clients and organisations within the UK, Australian and other global jurisdictions. Carmen is a former member of the Australian Accounting Standards Board. I'll hand over to Carmen now, who will proceed with the presentation.
Fantastic.
Thank you, Carmen.
Thanks, Nick. Welcome everybody to this session. So we are going to go through a range of different topics today. We would strongly encourage questions as we go. Obviously, any questions will be caveated by we haven't read any documents, but would love to have questions. So let's start by looking at our new standards for 30 June 2025. Now, we do have a list of these standards. Those of you who joined us in November may think that this looks a very familiar list, and it is. We actually haven't had any new standards effective for June that weren't in place for December. So for our June year ends, this is what we need to think about. For the vast majority of you, you probably aren't going to have huge impact for most of these standards. In fact, the only one I'm going to spend any time talking about is the top one. But before I move on to that, I do just want to give a brief reminder and an opportunity for me to get back a little bit on my soapbox around the second standard. The sale and leaseback amendment is a really minor amendment. It just makes sure we've got mirror accounting between both parties to the agreement. However, what I have been seeing quite a bit over the last 6 months or so is we have seen entities have entered into these sale and leaseback agreements, partly because of the current economic climate. So if you enter a sale and leaseback, you obviously get a big cash inflow through the door. However, what we need to think about is in order to have a sale under our accounting standards, we have to have lost control. And in many cases, the sale and leaseback is over the building. We don't lose control of the building, we're still occupying it, and we often have a buyback clause within those agreements. So if they exist, we generally have a failed sale, which means that we can't de-recognize the building, we can't recognize a gain on sale. So you have this really weird accounting. Now, while I'm not saying that the accounting should drive a business decision, just be aware that the financial impact may not be what you would expect it to be. It does look a little bit weird in that you're recognizing a lease liability, but you're also still recognizing the building that you own. The third one down is just disclosures, if any of you have entered into supplier financing arrangements. And the fourth one on the list is only for not-for-profit public sector entities. And I don't believe we have any of those on the call. So I'm not going to talk through that one. What I am going to focus on is that top one. So an amendment to AASB 101. So if we have a think about this particular standard, we have talked about it previously. We've spent a fair bit of time talking through some of the detail of that. So if you haven't had a chance to listen, join us in some of the earlier sessions, I would encourage you to look back. But if we just have a look at a couple of reminders on that particular standard. As I said, we've covered the theory. What it includes is more guidance around where you have a covenant. So it gives us information about, depending on when that covenant is tested, is it on or before the reporting period, or is it after the reporting period? And if it's after the reporting period, we can effectively ignore it for presentation purposes, that current, non-current testing. It gives us a lot more explicit guidance around if you have breached a covenant. So if we have breached a covenant, key message that I can tell you is please make sure that any correspondence to the bank and any correspondence from the bank where they may be giving you a waiver or a period of grace happens prior to year end. We do not have very many bright lines within our standard, but if we get a bank waiver, if we're a June year end and we get that bank waiver on the 10th of July, it does not count for presentation purposes. Your liability will still have to be classed as current at the year end date. You can disclose it as an event after the balance date, but it's a non-adjusting one. So please be aware, monitor your covenants. We are seeing a huge number of entities, unfortunately, are breaching bank covenants. And I think that is a condition of the current financial climate. There's also much more explicit guidance around facility rollovers and expiry facilities. So if you have a facility that is due to expire within 12 months of the reporting period, that is going to be classified now as current. It may, if it's a rolled facility, if it's constantly rolling over, some sort of revolving facility, you may be able to classify that as non-current, but make sure that you understand the terms and conditions of any of those agreements. Your auditors, those of you who are audited, will most definitely be asking more questions in relation to this space. So just make sure that we all understand what those terms and conditions are. Now, the other element of this standard is around disclosures. And the disclosures are potentially causing some challenges. So there's two elements of the disclosures. First is to give information about the covenants, including the nature. That one's not overly controversial. We haven't yet seen a best practice be established because this standard was only effective for the first time at 31 December. After we have our June year end, which is where certainly in Australia we have much more of those year ends, we'll start to get a bit of a feel for how much people are disclosing. So it's varying from we have covenants, which in my view does not meet the requirements because you're not talking about the nature. We have covenants that deal with liquidity and solvency. Yeah, arguably you are talking about the nature and covenant. We have covenants that cover liquidity, solvency, and include specifically, for example, the current ratio or any other ratios. And then we have some entities who are telling us what the ratio is and the amount that they have to comply with. So real variation of disclosures. The second part of this is the part that is potentially more controversial. So let's say we're a June year end and we have a covenant that is tested at the 30th of November. So we ignore that covenant for the purpose of presentation between current and non-current. But what this disclosure says is that if you've got this covenant that's tested at a future date and you are aware at year end of any facts and circumstances that might mean you have difficulty in complying with that, you need to disclose it. So an example could be if we were to test that at 30 June, even though we don't have to, but if we were to, we wouldn't meet that covenant. That's a fact and circumstance that might mean we don't meet the November covenant. And that's a disclosure that needs to be included. Now, as I said, we have talked about this previously, so I thought, well, what can I do differently this time that will give you a little bit more guidance? So I did have a dig around. I looked at a lot of December year ends and looked at a disclosure. Now, there is a lot of words on this next slide, but it's there just for your reference afterwards. This is a disclosure from a listed entity within Australia. Now, these guys have a lot going on. They have their facilities that are expiring within 12 months of the reporting period. So they tell us in that first paragraph, it all has to be classified as current. They've also, during the reporting period, had non-compliances with covenants. And they then go on to tell us what those covenants are, what the amount is, what are they doing about it. I'm not holding this up to say this is the best disclosure ever I've seen. I think it's a pretty good disclosure. And I just wanted to show you a bit of the words we're starting to see. Prior to this standard, we would not have seen a note this extensive within a set of financial statements. So just wanting you to be aware that this is what some of the public companies are actually showing in relation to this disclosure. At 30 June, we will see a lot more of them. Those of you who are listening that think that this may be relevant and you aren't listed, have a look at the listeds. They will publish before you, and there will be a number of these disclosures that are coming out. Now, having talked about that, I'm going to digress away to going concern, because obviously if you are potentially breaching a covenant, we could well have an issue with going concern. Now, those of you who have heard me talk before may remember I am a huge fan of the UK FRC. It is a government body over in the UK, the Financial Reporting Council, who put out some really quality documents in relation to the financial reporting space. This year, 2025, they have updated their going concern document. Their documents are written for preparers, so they are written for the people who are on this call. Slightly different rules in the UK, and they have to do solvency statements and strategic reports, but essentially they comply with IFRS as well. That document there, that's the front page of it. If you want to Google that, it will come up very easily. But I wanted just to show you a couple of things that were in this document. The first is they have a bit of a process to go through when you are thinking about going concern. Remember that although your audit team will ask you lots of questions on going concern, it is the preparers, it is management and the directors who have the responsibility to determine whether the going concern basis is appropriate or not. So this process is quite useful to work through. It starts off identifying a big pool of risks and uncertainties, and then you narrow down that pool, saying, okay, well, what is significant? What could be a real major risk that would happen? It does refer to a strategic report. That's a UK thing, but the rest of it is very relevant about thinking about disclosures. The next thing that this document does, but also I think is really useful, I'm allowed to use the word checklist, but this is almost a bit of a checklist that directors can use. So if we look at this, we've got lots of factors in here that directors and those charged of governance can think about in relation to going concern. Now, you may look at some of them and go, those aren't relevant to me. And that's fantastic. But if half of them are, it gives you the opportunity to go through and say, what have we thought about this? Do we need to change anything? Is this impacting our going concern? So it's a great starting point for structuring some of those discussions that need to happen. So all of that is in that UK FRC document. I really would encourage anybody who thinks potentially they may have any sort of going concern disclosures in their financial statements to have a look at it. It includes some good examples of disclosures, and it includes an FRC analysis on why they think it's good or not. We don't have ASIC who give us similar resources in Australia, so this is the next best place to go. So that's effectively our new standards for the year. Not a huge number. Potentially that current, non-current could have some impact for entities. I thought what might be useful now is to have a look at some contemporary issues that I think you probably need to have on your radar. So the first one, I am very grateful for Joel giving us an update on what Pillar 2 is from a tax perspective, because I am most definitely not a tax person. So we've heard Joel give us that update on Pillar 2. What I want to do is link that into the financial reporting aspect. AASB 112, which is our income tax standard, has been amended for Pillar 2. So as you can see from this slide, and I've just pulled this direct from the scope of 112, it says there that it applies to Pillar 2, but as an exception to the requirements in this standard, we shall neither recognise nor disclose information about deferred tax assets and liabilities. So what this is telling us is we need to take into account Pillar 2, but really from a current tax perspective, we can't be estimating what that future is around deferred tax. So let's have a look at what the disclosure requirements in 112 are. This has been added into the standard, and I've just pulled it out as a complete extract from that. So you can see we have disclosure requirements around the exemption for deferred tax. We have to separately disclose our current tax expense relating to Pillar 2. Joel's already gave us an indication of the fact that we have income tax reporting down the top. We have financial statements that need to be signed off now. So we need to make sure that we can't wait until the income tax deadline for putting in our tax return. This has to be considered as we are preparing our financial statements. So likely to have some significant impact for many of you for your 30 June 2025 financial statements. It's something I have to admit I wasn't overly aware of. I was very much in that it's a tax thing. It's really nothing to do with me, and I can happily ignore it. But as I've been talking to my client base, and given the threshold that exists, I've realized that many of these entities are actually subsidiaries of some fairly significant companies, and therefore there is potentially some impact in relation to that. The next thing just to talk about is something that is very specific to New South Wales. So anybody who is listening who is not from New South Wales gets to have a little rest for a couple of seconds. And it's something that many of you from other jurisdictions may be familiar with. New South Wales is introducing the Portable Long Service Leave Act for the community services sector. So effectively what that means is if you work in a sector and you move to a different employer within that sector, you are still covered for your long service leave. And we've seen that this is being commonly introduced in a number of jurisdictions, particularly in some areas where it is low paying, to try and encourage people to stay in that particular industry and keep that benefit. It's applicable from 1st of July 2025, and as you can see, is mandatory for both for-profit and not-for-profit entities who are deemed to be eligible. Now, an eligible organisation is an interesting definition. So what it says is where an employee does community service work. And as you can see from that third bullet point on the slide, it is where the employer either is providing community service, or they work for an employee where the predominant purpose of that is to provide community service. So let's say, for example, I was an admin person at an organisation who worked predominantly to provide community services work, and there's a pretty long list in the Act on what that is. So I might be working for an organisation that provides drug and alcohol counselling, for example. I don't do that. I'm not in that space, but I work for that employee. So it means that I am actually able to join this particular scheme because I meet that second criteria. So we're going to have people who do community services work who aren't at an entity that's what they predominantly do, but also people who don't do community service work who are at an employee, that's all that they do. So what we've effectively got is we put the funding into a scheme. It is based on a levy that is going to be determined each year. And it is the scheme who then bears the liability for the long service leave. Interestingly, this entity, the New South Wales government, has introduced the motivation, I guess, for everybody registering early. So what it says is if you register your employees within the first 6 months of the scheme starting, they get a bonus 365-day credit. So they do not have to work the 7 years. They actually only have to work the 6 years. That is a massive incentive for any of your employees who would be entitled to join this scheme. So I would encourage those employers who are listening, who are able to join the scheme or who are required to join the scheme, don't wait to register because your employees probably won't be overly excited if they don't get that extra year. In this scheme, the way this works is workers claim their long service leave directly from the scheme. So as the employer doesn't have to pay and claim reimbursement. So therefore your liabilities will decrease once the worker has entered into this particular scheme. So it's not effective for financial reporting until 30 June 2026, but particularly because of that first 6 months, I think that's really important for entities to be aware of. The next thing in my contemporary issue is the tariffs. And again, something we would probably all wish that wasn't happening, but we are seeing a huge amount of uncertainties around tariffs. We are seeing entities who have tried to break into the US and potentially have been really successful. And I've read a lot of small businesses who've just managed that. They manufacture in China and all of a sudden their prices have gone through the roof because of certain tariffs. So I just wanted you to think about if you do have any exposure to these, and we don't know what the retaliatory effects are going to be. Some areas just for you to think about here, inventories, and have we got inventories that we can no longer sell because the prices have gone up? Are we looked into an onerous contract because we were providing inventory on a fixed good basis? We're also seeing things like where we've got demand dropping for our products, having a flow-on impact for things like marketing and design and R&D, because entities can't afford to fund these particular services anymore because the revenue that they're getting from their good sales are dropping. So I just wanted to give you a little bit of a, don't forget this exists. It will potentially have an impact on financial reporting for some of you. Moving on again, we are going to look at some agenda decisions. So agenda decisions are where we've got a number of people in a number of jurisdictions using these standards, and they often write to the International Interpretations Committee and say, we think that this is unclear, we think it's not covered by a standard. And the International Interpretations Committee can do a range of things. The most common one that they do is they issue what we call an agenda decision. Now, techies like Michelle and I are all over these agenda decisions. Most of the people probably don't ever look at them unless there's a particularly controversial one. You may remember a few years ago, we all talked about software as a service. Given that we don't have some major standards for this year, I thought it would be useful just to give you a bit of a list of recent agenda decisions that have come out. So those since April, and then going forward, I'll probably do this on a 6-monthly basis. There's a few that may be relevant to you. Now, I'm not going to talk through each of them in detail. I'm just going to pick a couple in this bullet point list to talk through. First one in relation to climate-related commitments is where we have an organisation who has gone out there and said that they are going to be greener, they're going to reduce their greenhouse gas emissions. And the question relates to, at what point do we have a constructive obligation? And at what point do we therefore recognise a provision? So certainly that is something that if you are thinking of making these statements, be very aware that it may again flow through to your financial statements. The next one I just want to cover off is the recognition from tuition fees. So any of you who may be involved in education or that type of thing, this particular agenda decision probably sounds more interesting than it was going to be. The question effectively that is asked that could flow through to some other revenue streams is that we have 12 months worth of an academic year, but we are only teaching for 10 months of that academic year. Do we recognise revenue over 10 months or 12 months, even though our staff are involved in other processes during that remaining 2 months, but it's not directly impacting students? So there's a few interesting issues around that. The last one is guarantees issued on obligations of other entities. This may cover things like deeds of cross guarantee, guarantees for any banking facilities, and it gives us some guidance around which standard we may be in. Now, I'm going to come back to that first bullet point. So whilst it was all about provision, the committee did give us a really important reminder when they issued this particular agenda decision. So if we have a look at what they actually said, they said to us, irrespective of whether you have a provision or not, the actions the entity plans to take to fulfill that commitment would affect the amount at which it measures other assets and liabilities. So for example, if you are intending to be greener and you've got plant and equipment that is incredibly energy inefficient and it's churning out all sorts of gunk, and you thought that you were going to be using it and had a useful life for 8 years, might not anymore. It might be that the useful life has just all of a sudden been reduced to 2 because you want to replace it. You want to start being greener. So this is a great reminder that says, yes, we know we were asked about a provision, but just think about other things. Think about useful lives. Think about if we're trying to reduce plastic, does that mean that we have inventory that potentially we can't use anymore and we have to write that off? So if we think about our inputs, our estimates and our assumptions, think about the impact of climate and think about any particular statements that we have gone out and said. I'm going to stay on the sustainability perspective in our regulatory update because we haven't seen a lot from the regulator except in this space. So let's have a look at what we have seen as a bit of an update. First is ASIC. Now, last time I spoke to you, I talked about there were 2 cases that had gone through to court and those 2 had been finalised. There was one that had not yet been finalised and that was Active Super, formerly LGSS. Since I last spoke to you, that was then gone through the courts and they were awarded, not sure what the right word is, a $10.5 million penalty. So of the 3 cases that went to court, that was $34.7 million that those 3 entities have had to pay. We are not talking small change in respect of this. Now, just a reminder of this case, because I think it's actually quite interesting and a great lesson. I know most of the people on the call are finance people. This is something that is relevant for lots of people within your organization. So this particular entity said, we're not going to invest in anything that poses too great a risk to the environment. And you can see they list at that bottom left of the slide, certain industries. They also put out this triangle, and you can see in red writing, it says, no way will we invest in any of these. Now, their argument was that, well, any sophisticated investor would have looked at the terms and conditions and noted in the terms and conditions that we did say in certain circumstances we may invest in these industries. The court came out and said no way is very clear. No way means no way. And there's no way that anyone should have to go to the terms and conditions. So again, it's about that wording. But the other interesting thing is where all of these representations were made. So that list on the bottom right of the slide, you can see everywhere they made these statements. And every one of those was considered in the court judgment, including the website, emails that were sent out, PDSs, which is where you'd expect them to look at. But also the bottom one, an interview with the CEO. So I guess my message in this one is be very, very careful around where we are making these statements and what we are saying. If we can't support them, there are people out there who are very much looking for entities making unsupportable statements. That's from an ASIC perspective. The ACCC are also in this greenwashing space. So the ACCC recently had a court action against Clorox, who are the company that make Glad wraps and black bags. You can see from the picture on the slide, this particular slide said it was made from 50% ocean plastic recycled. Fantastic. We all think, what does that mean? It means they've gone out to the ocean, they've taken the plastic out of the ocean. Amazing thing to do. We have far too much plastic in our oceans and they've made bags of them. The small print, as you can see in my small print on the slide, said, well, you know what, it's kind of not from the ocean. It's 50 kilometers from the shoreline. But, you know, we kind of thought it was heading to the ocean. Really great thing. They're still getting plastic from the ground and recycling them. But the ACCC said it's not ocean plastic, though, is it? This entity was still fined $8.25 million as a penalty. So again, my key message very much is think very carefully about what you are disclosing in this space on your products. What's the impact on financial statements? $8.25 million and probably a significant loss of revenue. The huge expenses to fight these particular cases are going to be significant. So from that, I've finished on my work. I've done the sustainability, a bit of the scary bit. We're going to now flip to Michelle, who possibly is going to scare us even more with the climate and the sustainability aspect. So over to you, Michelle.
Thanks, Carmen, and hello to everyone that's joined us this morning. No, definitely not talking about scary stuff. We just got to embrace it and get going. So what I'm going to be covering today is the new mandatory sustainability reporting framework that's been introduced in Australia, starting with climate. So Carmen kindly just ended her session on a few greenwashing cases. And while the mandatory climate disclosures that I'm about to talk about aim to increase transparency and accountability, they do present a risk of increased greenwashing if entities cannot back their disclosures up. So this is important stuff. Anyway, we've been speaking about climate disclosures probably for the last 2 years at these updates. What we're noticing, though, is that the levels of awareness when it comes to the details of these new requirements are still relatively low, especially for Group 3 entities. So given I've got 25 minutes today, the aim of my session is to give you a high-level overview of the climate disclosures, which are set out in AASB S2, the first thematic standard that's dedicated to climate. And as you'll see, the disclosures are quite unlike the financial disclosures us accountants are used to. And the reality is that it's going to take some time and effort for in-scope entities to prepare for their first sustainability reports. So let's look at scope. You've probably seen this slide a couple of times over the past few years. So just as a reminder, climate disclosures will apply to those entities that firstly report under Chapter 2M of the Corporations Act, and secondly, meet certain size thresholds. And the requirements are being phased in, starting with the largest entities and emitters in Australia, and then extending to smaller, large entities sort of over the next 2 years. So I'm going to focus on the dark blue blocks. The first cohort of entities, Group 1 entities, they are no doubt in full throttle mode since climate disclosures have already commenced for this group of entities. They commenced on 1 January 2025. So for our December reporter clients, they are 4 months into their first year of mandatory climate disclosures. And they will have issued their first mandatory sustainability reports this time next year. That's quite a sobering thought. Group 2 entities, which are quite a bit smaller than the Group 1s, you can see the thresholds sort of halve. They commence reporting from 1 July 2026. It's probably that's roughly a year away, another sobering thought. And then Group 3s, which include any other large company under the Corps Act that's not a Group 1 and not a Group 2, they start reporting a year later from 1 July 2027. Registered charities, I'm not sure if there are any on the call today, but just take note, you're not subject to these new requirements as your reporting obligations fall under the ACNC Act and not the Corporations Act. And for entities on the call today that aren't within scope, would hate to leave you out. So perhaps you're not in scope because you're a charity or because you don't meet the size thresholds there in the table. You may be caught up indirectly because you sit in a reporting entity's value chain. And Nicholas will talk to that a bit later on. So what does all of this mean for in-scope entities? Well, they will need to prepare a sustainability report for inclusion in their annual report. So the sustainability report is going to sit right alongside the financial statements. And that means an entity's sustainability performance, impact on planet and people, will have equal prominence, equal importance compared to its financial importance. And that's a pretty fundamental shift in corporate reporting. The sustainability report is going to contain a climate statement, related notes, if any, and a director's declaration on the climate statement. Now, the disclosures that need to be made in the climate statement, they are set out in AASB S2, the climate disclosure standard, which I'm going to talk about briefly very soon. So when it comes to the director's declaration over the sustainability report, for the first 3 years, directors will only be required to give an opinion on whether the entity has taken reasonable steps to ensure the report is in accordance with the Corps Act and S2. So once this fixed 3-year period ends, that statement will become more definitive, declaring that the sustainability report is in accordance with the Corps Act and S2. It's a small but fundamental difference, and it just shows that that the expectation is that directors will enhance their capability, their understanding, their experience in relation to sustainability reporting over the next few years. Now, some of the disclosures required by AASB S2 are very forward-looking or are subject to significant measurement or outcome uncertainty. So to encourage robust disclosures, but at the same time acknowledge that entities may not get it quite right in the beginning, despite their best efforts to do so, the normal liability settings have been modified. So for a fixed period, only a regulator such as ASIC can take action against a company for misleading and deceptive conduct when it comes to certain protected statements made in the sustainability report. And those protected statements that I refer to, you can see them in the table on the slide. So it's any statement that's climate related, which at the time that statement is made is about the future. And those statements have a fixed modified liability period of 1 year. So it's applicable to reports prepared for financial years commencing between 1 Jan 25 and 31 December 25. The other protected statements, as you can see, it's about Scope 3 greenhouse gas emissions, scenario analysis, and transition plans. They are probably the trickiest disclosures that entities will be making. These statements have a fixed modified liability period of 3 years. So this applies to reports prepared for financial years commencing between 1 Jan 25 and 31 December 2027. And it's interesting that when you look at the transitional relief related to the directors' declarations and the modified liability settings, it's the group 1s that benefit the most, and it's the group 3s that benefit the least, which some might argue isn't particularly fair. So moving along, let's talk about assurance. Of course, to give credibility to the climate disclosures, they will be subject to assurance. A new sustainability assurance standard has been issued internationally. It's called ASSA 5000, and we've adopted it here in Australia. So it's a standalone standard that sets out the assurance requirements covering the end-to-end audit process for sustainability assurance engagements, from client acceptance and continuance all the way through to reporting. And in Australia, it will be the entity's financial auditor that signs off the sustainability audit reports, of course, supported by experts in the field of sustainability and climate. So on the slide is the assurance phasing for Group 1s with financial years commencing between 1 January 2025 and 30 June 2025. So these entities will be subject to year 1 provisions twice. So for their first and their second years of reporting. So for their first 2 years of reporting, as you can see, partial limited assurance will apply. So only specific disclosures will be subject to limited assurance as a minimum. And of course, limited assurance refers to the same level of assurance that applies to a half-year review, during which the auditor does less extensive procedures than when providing reasonable assurance. Important though, the fact that many of the disclosures won't be subject to any level of assurance, as indicated by the none in the table, it doesn't mean those disclosures don't need to be made. Entities must still comply fully with the requirements of S2. It's just that the auditor won't have to express any form of opinion, whether negative or positive, on those disclosures. Now, the only difference between year 1 and year 2 relates to Scope 3 emissions. As part of the transitional relief afforded under S2, Scope 3 does not need to be disclosed in the first year of mandatory reporting, hence the NA, not applicable, but must be disclosed in the second year of reporting, with assurance over Scope 3 emissions commencing from year 3 for these entities. And in years 3 and 4, all the disclosures will then be subject to limited assurance. And then from the 5th year of reporting, the auditor will have to provide reasonable assurance over all the climate disclosures. So the same level of assurance that is provided in a financial statement audit. Now, this slide applies to Group 1 entities with years commencing on or after 1 July 2025, as well as all Group 2s and all Group 3s. So the assurance pathway is quite similar to the previous slide. It's just that these entities are subject to the year 1 provisions for only 1 year, not 2 years. So partial limited assurance will apply in the first year and the first year only. That will increase to limited assurance in years 2 and 3, and then reasonable assurance by the 4th year of reporting. So let's talk about AASB S2, starting with what the standard is all about. So just as a reminder, 2 sustainability disclosures have been issued in Australia, AASB S1 and AASB S2. I'm only going to talk to S2 today, and that's because in Australia, to support the government's climate first approach, it's only S2 that has been issued as a mandatory standard. S1, which covers sustainability more broadly, is only a voluntary standard at this stage. So what this means is that entities caught under this new climate reporting regime do not have to report on sustainability topics beyond climate. And of course, that is going to change in future as more thematic standards are developed and issued. I mean, the International Sustainability Standards Board, or the ISSB, is currently researching biodiversity and human capital to understand what information on these 2 topics would be useful to investors. So it's a pretty safe bet that biodiversity and human capital will be the next 2 thematic standards. S1 houses all the foundational concepts and requirements for preparing and presenting sustainability information. But as I've just said, S1 is voluntary at this stage. And so for S2 to operate as a standalone mandatory standard, these foundational concepts have been included, they've been borrowed from S1 and included in a separate appendix to S2. And I'll talk about this appendix a little bit later. Some of you may have heard of the Task Force for Climate-Related Financial Disclosures, or the TCFD. This was a framework that many entities use to voluntarily disclose their climate-related risks and opportunities. So it made sense for the ISSB to leverage off this existing framework when developing S1 and S2. So S2 incorporates all 11 of the TCFD's recommended disclosures, plus more. And the disclosures required by S2 are all about providing information about the climate-related risks and opportunities that could reasonably be expected to affect an entity's prospects. And by prospects, I mean its cash flows, access to finance, and cost of capital. And that's over the short, medium, and the long term. When I say risks, that includes physical risks, which are the physical impacts of climate change. So think cyclones, flooding, wildfires, etc., and as well as transition risks, which are risks that arise, things like policy or market or technological risks that entities may face as we transition to a low carbon economy. So moving over to the right side of the slide, why do entities need to be making these disclosures? Just like accounting standards, S2's target audience is primary users of general purpose reports. So what information do these primary users need to make informed decisions? And by ensuring that climate-related risks and opportunities are clearly disclosed, users are able to understand how these factors might impact on an entity's financial position, financial performance, and cash flows over the short, medium, and long term. And also how the entity plans to respond so that it will actually be around in the long term to be able to continue creating value. So if we move to the next slide, I mentioned that AASB S1 is only a voluntary standard in Australia for the time being, but it contains some really important concepts for the preparation of sustainability reports, similar to AASB 101 when it comes to the preparation of financial statements. So these concepts, which are needed for S2 to function as a standalone standard, have been plucked from S1 and dropped into Appendix D. And this Appendix D is an integral part of S2, AASB S2, as it contains the overarching requirements that entities must comply with when preparing and reporting climate disclosures. And you as preparers of financial statements will be familiar with quite a number of them. So for example, the need to disclose those judgments that have the most significant effect on the information presented so that users can understand their impact on the climate disclosures. And this is going to be really important considering the forward-looking nature of many of the disclosures and also the measurement and outcome uncertainty involved. So materiality. So while the context in which we're applying materiality is different to what we're used to, materiality in AASB S2 is the same financial materiality concept we use for financial reporting purposes. So information is material if its omission, misstatement, or obfuscation could influence the decisions of the primary users of that information. I want to point out comparative information only to highlight that under the transitional relief in S2, comparative information is not required in the first year an entity prepares its climate statement. Perhaps a slightly newer concept is that of connected information. So put really simply in Michelle's words, everything needs to stack up when compared to other information, and that's within the sustainability report, as well as other information in the financial statements that will be sitting right alongside the sustainability report. And I think Carmen actually mentioned it in her session. So for example, if your sustainability report talks about an emissions reduction plan that involves moving away from energy intensive assets towards greener assets over the next 5 years, well, how is this reflected in the residual values and useful lives of those existing assets in the financial statements? So let's take a very, very quick look at, I'd say it's not all, some of the disclosures contained in S2. There's a fair number, but I just want to give you a flavor of the type of information that in-scope entities will be reporting. So when you open AASB S2, you'll see that the disclosures are arranged quite neatly under 4 key headings: governance, strategy, risk management, and metrics and targets. This structure is borrowed from the TCFD, and I guess it gives entities a bit of a framework to use when thinking about their climate-related risks and opportunities. So if we start with governance, these disclosures are about providing users with information about the governance framework or structure that an entity has in place to monitor, manage, and oversee climate-related matters. And this is useful information because it allows users to evaluate the extent to which climate-related matters receive attention and from whom. So if you look at those disclosures, who is charged with oversight of climate-related risks and opportunities? Is it the board? Is it a subcommittee of the board? Is it a special committee? Is it an individual? That's what that disclosure means. How are climate-related responsibilities incorporated into the broader governance framework in charters, in terms of reference, in role descriptions, etc.? Also, how often are those charged with oversight informed about climate-related matters? Is it once a year? Is it, quarterly, etc.? And then also, what is management's role in managing and overseeing climate-related risks and opportunities? If we move over to strategy, the strategy disclosures provide information about the entity's specific climate-related risks and opportunities, how these are addressed and managed, and also how these interact with the entity's strategy, business model, and value chain. So I would say these are probably the trickiest disclosures. There are a number of disclosures under this subheading, strategy. I think it's close to 30. And this is the best way that I could summarize all 30 of those disclosures on half a slide. So this section requires the disclosure of the entity's specific climate-related risks and opportunities, probably one of the biggest judgments that an entity will make, and how these risks and opportunities could impact the entity's business model and strategy over the short, medium, and long term. So this standard takes a longer term view. There are also disclosures that require quantification of the financial effects that those identified climate-related risks and opportunities could have, both current and future. And the really interesting one, information about the ability of the entity to withstand various climate futures, what the standard refers to as a climate resilience assessment. So to inform this assessment, entities will need to do some scenario analysis, play the what-if game to understand how it will fare under different climate futures and what actions it will need to take to remain resilient. And just the last thing on scenario analysis, in terms of the scenarios that entities need to consider, S2 is not prescriptive, but the Corporations Act has mandated a minimum of 2 scenarios that in-scope entities will have to consider. There's a low warming scenario, one where global warming is limited to 1.5 degrees Celsius above pre-industrial levels, and a higher warming scenario where this well exceeds 2 degrees Celsius. So just be aware of that mandatory Corps Act requirements. All right, disclosures about risk management. So these provide users with information about how climate matters are identified, assessed, and managed, and whether those processes are integrated into existing risk management processes and frameworks. I wouldn't say they're the most exciting. I'll let you have a read of those. I guess the last dot point is an important one. So if and how these risk management processes are integrated into the entity's overall risk management process. Because really, climate and sustainability more broadly shouldn't be considered separately, but should be integrated into an entity's existing risk management framework. If we look at metrics and targets, providing information on metrics and targets allows users to understand how the entity has performed in relation to its climate-related risks and opportunities, including progress towards any climate-related targets that it has set or has to meet by law. So it's this section that requires disclosure of an entity's carbon footprint, disaggregated between Scope 1, Scope 2, and Scope 3. I would say this is probably, Scope 3 will be tricky, but with the plethora of softwares available to help entities calculate their carbon inventories, this is probably going to be the disclosure that's going to cause the least, some of the least hurt. So this is what's driving the rising interest in carbon accounting. It's this specific disclosure, and Nicholas will talk about this a bit more. Some of the other disclosures, these are mainly quantitative. As you can see, the dollar and percentage of assets and activities that are exposed to risks, both physical and transition climate risks. How much is the entity spending, whether through financing or investment, to address the identified climate-related risks and opportunities, and also some detailed information about any climate-related targets and the metrics used to monitor those to monitor progress. So I think I'm nearly done. Entities have a lot to think about, and I guess it can be quite daunting to know where to start, but just start. That's probably my key message today. If you are in scope of these climate disclosures, do not underestimate the time and effort that's going to be needed to be in a position to report and have your disclosures stand up to audit scrutiny. So some actions that entities should be taking now, if they're in scope, if they haven't started to do so yet. Firstly, and probably the easiest thing to do, is just have a read of AASB S2. Get comfortable with the disclosure requirements and start thinking how systems and processes will need to change, especially when it comes to data collection. Start to upskill the necessary people so that you can establish cross-functional roles or teams to handle the reporting responsibilities, including the collection of data. Dealing with these disclosures is certainly going to be a team sport. There are some aspects of the disclosures that will be complex and resource intensive. So things like setting your boundaries for purposes of calculating your greenhouse gas emissions, also scenario analysis and scope 3 calculations. So start identifying potential experts that could assist you with these more technical areas. As I mentioned earlier, climate should not be considered separately when identifying and managing risks for your business. So start to take steps to ensure that climate risks are embedded into board level oversight, strategic planning, and also financial decision-making processes. As an organization, start to identify and assess your climate-related risks and opportunities. And that's not only within your own operations, but within your value chain as well. So think about who should be involved in this process and who will sign off this final assessment. It's probably going to be one of the biggest judgments that entities make. As you saw, entities must disclose their carbon emissions split into scope 1, scope 2, and scope 3. So find a software like Someday that can help you do this and just get cracking on measuring your emissions. Some of you may need this earlier than required by mandatory reporting, depending on who your customers are. They may ask for your emissions data earlier for purposes of their scope 3 reporting. And lastly, consider engaging with your external auditor as early as possible in the implementation process, and that's to gain a bit of comfort, so to gain pre-assurance on the data and information being reported before mandatory assurance requirements are introduced. So these slides will be shared with you today after today's presentation. So I thought I'd just share a few links to resources that I've certainly found useful as I'm learning, including AASB S2 itself, which is a really good place to start. ASIC has also issued a guide, regulatory guide 280 on the sustainability reporting regime, including how it's going to enforce in the early years. So I do recommend having a good read of this. And then finally, we also continue to develop guidance for our clients. So Group 2s and 3s on the call today, if you need a bit of inspiration about how to get going with developing a roadmap leading up to your first mandatory sustainability report, take a look at the guides that we've prepared. And there's also a quick reference guide to carbon accounting for those interested in getting going with their carbon inventories. And Nicholas, I believe I'm handing over to you.
Thank you, Michelle and Carmen. Very insightful. Many things for all preparers of financial statements to be thinking about over the coming months and years. I'm going to follow from Michelle's discussion on emissions measurement in particular. So Michelle had a deep dive into the requirements for those who are going to be needing to mandatory prepare and report financial statements. But we've also observed many use cases why organisations who may fall outside of the mandatory climate-related reporting regime may want to commence their journey to capture data and measure their own carbon emissions measurements. So what I'll briefly explore now is sort of a high level, what are greenhouse gas emissions. There's many acronyms that are used, and we'll just quickly explore those for those who may not be familiar. We'll consider how greenhouse gas emissions are measured and understand how sustainability outcomes can align with strategic goals of an organisation. So this is the concept that going beyond compliance, there is great value for many organisations to consider and potentially take action to both reduce their emissions within their organisation, but consider sustainability more broadly. So what are greenhouse gas emissions? So while a lot of the terminology that you may be exposed to now may seem new, the general concept around greenhouse gas emissions and the protocol that underpins the scope 1, 2, and 3 emissions, which are used to and heavily used within the reporting regimes, aren't new. The GHG protocol was developed from the late 1990s. It's been quite broadly used both in the Australian context and internationally for longer periods of time. The idea of scope 1, 2, and 3 is to classify emissions which an organisation has impact, or they impact on the organisation. Scope 1 are the direct emissions from sources that an entity owns and controls. So that's where you may be producing emissions within your own organisation. Scope 2 is largely the indirect emissions which are associated with purchased power. And so that again is quite, in most organisations, quite sort of easier to capture and measure. And then scope 3 is presenting that, I guess, the greater challenge for the wider economy, and that's all other emissions associated with an entity's activities, both upstream and downstream. And these are often considered to be emissions which are outside the control directly of an organisation, but do factor into the inputs either that you acquire within the activities of your organisation, or the future impacts of your products or services. And that's an area where much thought needs to be put into when trying to set that emissions boundary and measure those emissions. So the next diagram here, this is again a diagram which is sort of extracted from the GHG protocol, and it sort of gives in a sort of pictorial landscape what are the emissions. So the scope 1 that you see there in the middle, if you think about those, they're directly associated with the company's facilities. So if what you may be producing, if you're an energy producer or emitting gases, operating company-owned vehicles and the like. The scope 2 emissions, as I mentioned, they're the purchased electricity, largely for heating, cooling, and the like. And so often that's again directly measurable by your purchased electricity, by your electricity providers. And then the scope 3 emissions, as you can see here, both in the upstream activity. So that's everything associated with your purchased goods and services, and your employees' activities, whether they're commuting and other business activities that you bring into your organisation. And then your downstream activities, so through your distribution of your products and services, how those products are used and passed along, and even considering the end of life of those products. So considering those boundaries and the materiality of each of those is a real consideration, as Michelle pointed out in her slides, if you are going down the mandatory reporting regime. But where the commercial imperative really is starting to fall for many organisations is that even if you're outside of that reporting regime, you can see how your activities may be falling into the scope 3 emissions of another entity who's reporting, and if so, they're going to be starting to ask you for information around those. So having an understanding of your activities and where they fall into the wider economy is going to be important. So how do you go about measuring your emissions? There is sort of orderly processes that can be followed. It is a process which is maturing, and there's, I guess, abilities to quite efficiently and effectively measure your baseline emissions. And the first step there is to determine your boundaries. So consider what is within your control, and then identifying sources of the emissions. Considering your calculation approach, collecting data, and as Michelle pointed out, data collection within any sort of climate reporting or measurement is critical. And there's often information that's sitting outside of traditional finance systems and processes. So understanding where in an organisation that data might sit is important to understand. The step 5 here is using calculation tools, and this is where we've seen sort of big advances recently. There's emerging technologies and solutions which make the measurement and calculation of emissions a more, I guess, straightforward and approachable approach for many organisations. And then the step 6 there is really the sense check. So having a look at this data, aggregating it across your organisational activities, and then thinking about how you might use that data to report to potentially internal stakeholders and external parties. And when I say report here, this is potentially reporting and sharing outside of the mandatory disclosure regime. So where stakeholders may be interested in that information. So HLB, we are helping many organisations down this path. We're working with our technical partners in some of these engagements. So we work with an organisation called 2XE. They're specialist climate scientists and engineers. They can assist in developing strategies and decarbonisation pathways. And one of the tools that we are using to help our clients capture and measure their emissions data is a platform called Someday. Someday is effectively a carbon accounting tool. It can quite simply and straightforward help organisations to start their carbon measurement journey. And it is a platform which is readily accessible. So if you've got interest in starting your journey, please reach out to one of your HLB contacts. So why would you be interested? So you might have looked at Michelle's slides and had a bit of relief that you might have fallen outside of one of those mandatory disclosure regimes. And so from a compliance perspective, it may not be something that's going to be on your near-term radar. But as I mentioned, the Scope 3 supply chain is really going to capture many organisations much more broadly than those who will be mandatory reporting. So understanding who might be asking for information from you in the near term, whether it's one of your key customers, or if you're subject to government funding or grants, or we're seeing more so finance providers as well are asking for information. So there's a broader group of stakeholders who are going to be looking for organisations to be able to provide them with some baseline carbon information, and potentially are starting to understand how you may be looking to reduce your emissions profile of your organisation. Michelle touched on the risk management perspective around fiduciary duties. That's something which needs to be considered, but I'm also thinking about the social license. So there's a growing expectation of staff, others within the community who may be accessing your services for you to be taking action as well. All right, so the key steps, so this is quite similar to some of what Michelle mentioned. Start by understanding who may be interested in your organisation, in your sustainability position. So they could be your clients, could be your staff and board, regulators, and potentially funders and government agencies. Collaborate. It's really important that you start to, from an all of organisation, to think about who within your organisation can assist in taking you on this journey. It may be your finance team, it may be others sitting around your organisation, from procurement to other entities, others. So think about who can be involved and start putting a plan together. And really, to achieve maximum benefit out of your sustainability journey, think about integrating sustainability into the core strategy of your organisation. It's unlikely that you can achieve material progress or gains if you look to run it as a separate agenda item folded into the core strategy. What we're seeing is that organisations who do take positive action to reduce their carbon emissions may also be able to achieve efficiencies across their organisation, whether that be on cost or other areas. So if you think about where greater energy intensity is in your operations, that may also result in sort of sources of expense as well. So being able to reduce your carbon emissions by also reducing your financial benefit to your organisation is a win-win, and also being able to further advance the commercial intent of your organisation, but potentially putting you in a position to win new business or attract broader customers or employees to your organisation is a benefit. Similar to Michelle, there's various publications here which can help provide you some further information and help you advance your sustainability journey. So please access those and reach out to any of the team here if you'd like some further information. We will look to wrap up the session. So look, I would like to thank my fellow presenters for their time today. So thank you, Joel, Carmen, and Michelle. Thank you very much for your attendance, and we look forward to catching up with you again soon.